If you had an extra £500 or $500 per month, would you throw it at your mortgage to be debt-free sooner, or would you invest in the stock market and let compound interest do its magic? This is one of the most debated personal finance dilemmas, and the answer isn't as simple as you might think.
Absolutely. Now, both options have strong arguments, but some unusual and compelling reasons go beyond just crunching the maths. So let's dive into the financial and emotional aspects of both choices with practical examples, research-backed insights, and strategies to help you decide.
Today's video will be split into a few parts, okay? So part one is all about why paying off your mortgage early can be a game changer. Part two is then looking at the maths. So the maths of investing in the stock market versus the mortgage overpaying. Part three is then looking at unusual and compelling reasons why paying off your mortgage might be the thing to do. Then we move on to part four, which looks at unusual and compelling reasons to invest in the stock market.
Part 5, we're going to be looking at non-financial considerations in making a decision. Part 6, we're going to be looking at combining the best of both worlds. Part 7, we're going to be looking at the practical tips for making your decision. And part 8, we're going to be concluding. So make sure that you stay until the end of the bonus tip, which is going to be the option we prioritized on our journey to financial freedom.
My name's Ken.
And I'm Mary of the Humble Penny and Financial Joy Academy. Together, we're Sunday Times best-selling authors of our Financial Joy book, which is a 10-week plan to help you banish debt, grow your money, and unlock financial freedom. We will link to it above and below for you to check out in your own time.
If you're really enjoying today's video, we'd really massively appreciate you doing us just one favor. Literally over there somewhere, just hit the like button and give us a signal that you are enjoying today's video. All right, let's dive straight in. Now, part one is looking at why paying off your mortgage can be a game changer. We're going to just run through some of the reasons before we move on to part two. The first reason is guaranteed returns. When you pay down your mortgage, you effectively earn a return equal to the mortgage interest rate. For example, if your mortgage interest rate is 5%, every pound or dollar you pay saves you 5% annually in interest. That's a guaranteed return, something that the stock market can never promise. Now, take the example of a £200,000 mortgage at 5% interest rate over 25 years. Paying an extra £500 a month could save you over £73,000 in interest and cut your mortgage term by 11.1 years. Imagine the peace of mind knowing you are debt-free ahead of schedule.
Absolutely. And number 2 is the emotional power of debt freedom. Psychologically, owning your own home outright is freeing. A 2018 study from Harvard Business School found that people experience higher levels of happiness when they reduce debt compared to when they accumulate wealth. So debt can be stressful, and even if it's good debt like a mortgage, eliminating it gives you the financial security and flexibility.
3 is to recession-proof your finances. Mortgage-free living means one less bill to worry about if times get tough. Whether it's that you're experiencing a job loss or a recession or an unexpected expense, having a fully paid off home can significantly reduce financial stress.
Yeah. Number 4 is to simplify your retirement. If you aim to retire early or live off a smaller income in retirement, then not having a mortgage payment simplifies your budgeting. Without this monthly expense, your income requirements drop dramatically, making financial independence or optional early retirement more achievable. Now, this was one of the biggest appeals for us, especially having seen both of our parents retire and they still had the mortgage to pay. Now, I'll link below and above to a popular video we make titled Renting in the UK, the shocking truth about your retirement future.
Yeah, popular one. Let's look at part 2 now, which is the maths of investing in the stock market versus mortgages and why investing in the stock market could be a better bet. The stock market has historically delivered an average annual return of around 7 to 10% after inflation. Thinking long term here now. Over the long term, this beats the typical UK or US mortgage interest rate. Let's use a real life example to illustrate this. Now, up on the screen, you see some mortgage details. Let's say the loan amount for a mortgage is £200,000. Interest rate is 5%, assuming a fixed rate mortgage. And let's say you've got a standard term of 25 years. Monthly payments in that example, without overpayments, will be £1,169.18. And the total interest over the term will be £150,753. Now let's look at the mortgage overpayment scenario. By overpaying £500 per month, the monthly payment becomes £1,669.18. The mortgage is paid off in 13 years and 11 months instead of the 25 years, wiping off 11 years and 1 month off at the mortgage term. Total interest paid would be £77,641, and interest saved in that period would be £73,112, which is £150,753 minus the £77,641.
That's right. Now let's look at the investment scenario. This assumes the same term of 13 years and 11 months. Investing £500 a month in an index fund with an 8% annual return compounded monthly for 13 years and 11 months. So using the compound interest formula, the investment grows to approximately £153,511. Now, a quick pause to say, please take a moment to subscribe to our channel. Every single subscriber matters to us, so a massive thank you in advance.
Okay, so now we've looked at those two scenarios there, mortgage overpaying and trying to pay it off versus the stock market investing. Let's now compare what that actually looks like and summarize it over the same 13 years and 11 months term. The mortgage overpayments savings in that period would have been total interest saved of £73,112. The mortgage is fully paid off, offering peace of mind and a big part of financial freedom. Now, with the stock market investment growth, total value of the portfolio would be £153,511. Here you have potentially higher returns, of course, though with market volatility risks attached. Now, reflecting on this, the key insights that come from this particular scenario are that, number one, with a 5% mortgage rate, the difference between the two options actually narrows, but the stock market investment still generates more wealth over time. In this case, that 153k versus the 73k savings in interest. The second insight is that in this scenario, the stock market is expected to generate over double the amount saved in interest for a mortgage. The third is that this is still the case even after accounting for taxes and inflation. Next is that, remember though, that the stock market return is not guaranteed. This is so important to mention, whereas the mortgage return is 100% guaranteed. And a couple more things worth mentioning are that future stock market returns may not be as generous as they've been for the last 15 to 20 years where we had record low interest rates. And the final point is that you also have to consider your stock market investments in terms of how they're made, whether they're made within an ISA or outside of a tax-free environment, for example.
Number two is to diversify your wealth. Your home is an asset, but it's not liquid. By investing in the stock market, you're diversifying your portfolio and building a safety net that you can tap into when needed. This approach reduces the risk of being house rich but cash poor.
Yep. Number three is to keep up with inflation. So mortgage payments remain relatively fixed, excluding, of course, variable rates, but investments can grow to outpace inflation over time. This means the purchasing power of your wealth increases over time.
That's right. Number four is to leverage low interest debt. Now, if your mortgage rate is low, for example, 2 or 3%, it might make sense to keep the debt and invest your extra money at a higher return. And this is known as good debt leverage and is a strategy used by many wealthy individuals.
Let's now look at unusual and compelling reasons to pay off your mortgage early. Number one is the freedom to pursue unconventional dreams. Now, being mortgage free can open doors to life changes like taking a career break, for example, starting your own business or working fewer hours. It's a lifestyle choice as much as a financial one based on our personal experience, and this is one of the biggest reasons why we personally chose to pay off our mortgage early. I wanted to leave my super stressful career in finance and explore something more creative, suited to my lifestyle as a dad, for example. In addition, the 9-to-5 grind was literally destroying my overall quality of life and well-being. Without paying off the mortgage earlier, backed by other investments in our lives, I literally would not have been able to take that leap to focus fully, and comfortably doing something like running the humble penny, for example.
Number 2 is the sleep factor. There's a psychological comfort knowing that you truly own your own home, and no market crash or job loss can take it away from you. And this peace of mind or mental freedom can be worth more than financial returns.
I love that. Number 3 is legacy building. So paying off your mortgage can free up your estate for future generations. A paid off home provides a tangible, stable asset to pass down to your children, for example, or other loved ones. Although you do have to, of course, be aware of inheritance taxes you might have to think about in the future, but this is also something to be concerned about if you did invest in the stock market instead.
Yeah. So part 4, we're going to look at the unusual and compelling reasons to invest in the stock market. So number 1 is to hedge against rising rates. Now, if inflation rises, your mortgage interest rate could increase if it's variable. By investing, you build a buffer that grows with inflation, protecting your future purchasing power.
I love that. Number 2 is flexibility with opportunities. So investments can be sold, as you know, and used as collateral for other ventures like buying rental property or funding a child's education and so on. And this flexibility should not be understated. It doesn't exist when you have all your money in home equity, unless of course you come to refinance, for example.
Yeah. And number 3 is opportunity cost of time. Now, the earlier you start investing, the more time you have to take advantage of compound interest and growth. Now, delaying investments to focus on, say, your mortgage could mean missing out on the years of market growth.
This assumes you only focus on the mortgage, obviously.
Yes.
Okay. So part 5 is now looking at non-financial considerations in making this decision, because I know it's actually quite hard to make this decision. Here are some things to consider. The first is your personality and risk tolerance, okay? Now, if you are risk averse, paying off your mortgage might feel safer. If you are comfortable with market fluctuations, investing could align better with your goals, for example.
Yeah, and to add to that, number 2 is life goals. So if you're aiming for an early retirement or a change of career, or do you value debt-free life more, then your personal priorities will actually shape your decision.
Number 3 is looking at family independence, okay? As people who have children, if you have a family yourself, for example, the security of a paid off home might outweigh potential investment gains. Conversely, if you are young and single, you might think, actually, do you know what? I prioritize growth over safety, and that's going to be my main focus.
Yeah, and number 4 is job loss or income reduction. Now, let's look at this scenario and consider this in 2 scenarios. So the first scenario is the mortgage overpayment scenario. Now, if sadly you lost your job or faced reduced income, having an overpaid mortgage offers no liquidity. So the extra money that you put into the mortgage cannot be easily accessed without selling or refinancing the property, which may be challenging during a financial emergency, for example. However, once the mortgage is fully paid off, your mortgage outgoings simply reduce significantly, offering a safety net.
I love that. Again, looking at that same scenario, but looking at it from the stock market angle, investments in the stock market are, of course, a lot more liquid. In an emergency, you can sell some shares or funds or whatever to cover your expenses. On the downside, if the job loss does coincide with a market downturn, which is something most people ignore sometimes, you might have to sell investments at a loss, reducing their effectiveness as effectively a safety net. So a key takeaway here is that investing provides liquidity and flexibility, while overpaying your mortgage offers eventual financial security but no short-term accessibility.
Yeah. Let's look at number 5 in the case of a serious illness or disability. Again, let's consider this in 2 scenarios. So the first scenario is the mortgage overpayment scenario. Now, a serious illness can limit your ability to work, and an unpaid mortgage could become a financial strain. There is evidence suggesting that illness rates have increased post-COVID, particularly due to conditions like long COVID and rising mental health issues. Furthermore, disability benefit claims in the UK have surged post-pandemic, with significant rise in claims related to mental health conditions. However, if you're already paid off the mortgage, your financial burden is significantly reduced. So if you're still in a process of paying off your mortgage early, the overpayments might leave you with less cash to cover other expenses, and you may need to scale this back.
Yeah, I think that point about health is a big reality for a lot of people.
A lot, yeah.
Yeah, again, let's look at this illness perspective from a stock market perspective. Investments can act as a financial cushion in this scenario, offering liquidity for unexpected medical costs and that sort of thing. However, reliance on the stock market during illness adds uncertainty, actually, as the value of your portfolio might fluctuate when you need it the most. Plus, illness limits your earning power, limiting your disposable income and the ability to invest more funds over time. So the key takeaway is that a paid off mortgage eliminates the risk of repossessions during a health crisis, for example, whereas investments can offer liquidity for big emergencies like medical expenses that you might not have planned for, or you might need during a time of difficulty.
Yeah. Point number 6 is general financial emergencies. Now, let's look at these 2 scenarios again. The first is the mortgage overpayment scenario. Overpaying your mortgage reduces financial risk in the long term, but it ties up capital in illiquid assets. And during an emergency such as a major home repair or unexpected family expenses, you can't access the equity easily and will need to make sure that you have an accessible emergency fund.
Yeah, absolutely. Again, tied to that when it comes to emergencies for the stock market scenario, stock market investments obviously are more accessible for emergencies depending on what you invest in, obviously, offering a more readily accessible pool of funds. However, timing matters, yeah? So if the emergency happens to coincide with a bear market, for example, the funds available may be less than anticipated.
Now let's move on to part 6, combining the best of both worlds. Why not do both? You can split your extra money between paying down your mortgage and investing. For example, put 70% towards your mortgage for peace of mind and invest 30% for long-term growth, or vice versa. This balanced approach ensures that you're making progress on debt whilst building wealth, and you can then adjust these percentages to suit your goals.
I love that. We're coming close to wrapping up. Let's look now at part 7, which is practical tips for making your personal decision. The first tip is to calculate your effective mortgage rate and then compare your mortgage rate to the potential returns from investing in the stock market. If your mortgage rate is higher, paying it off might make sense, okay? Tip 2 is to consider tax implications. In the UK, for example, tax efficient accounts like the ISA or your pensions make investing a lot more attractive, okay? Tip 3 is to then run the numbers. So use online calculators like we've done to see how different scenarios play out over time for you personally.
Tip 4 is to focus on your goals and personal circumstances. So decide what matters most to you personally, security or growth. And tip 5 is to build an emergency fund first. So before choosing either strategy, ensure you have 3 to 6 months worth of living expenses in a liquid accessible emergency fund. Now this mitigates the risk of financial hardship during unforeseen circumstances. Tip 6 is to consider income protection insurance. To safeguard against any job loss or illness, consider income protection insurance, which can cover your mortgage payments or other living costs if you're unable to work.
I love that. So key, insurance.
Important.
Now, coming to conclusion. The conclusion really with this video is that ultimately, whether you pay off your mortgage early or invest in the stock market depends on your personal circumstances, goals, and your risk tolerance. The smarter move is not just about what makes sense in terms of the logical numbers and the maths and so on. For some people, the emotional relief of being debt-free is absolutely priceless.
Yeah.
For others, the potential returns that comes from the stock market, for them is a complete no-brainer.
Yeah.
Now, whatever you decide to do, the key is to actually take action. Even small steps like putting an extra £50 a month, towards your mortgage or towards an investment in the stock market can have significant impact over time.
Yep, absolutely. And for the bonus tip, here is what we did. Right, so in our 30s, we paid off our mortgage in 7 years rather than 25 years, and we did it whilst also investing in a stock market. Now, whilst the maths was important, it wasn't the only consideration. So we had zero regrets, and we see it as one of our best financial decisions.
I love that. And obviously, on the back of paying off the mortgage, today it means that a bigger proportion of any income we generate, it actually, outside from being spent on enjoyment, goes towards investing further in the stock market, for example, to top up our freedom fund. The question is, here's a question for you. Which will you choose? Let us know in the comments below. Are you prioritizing investing in the stock market, or are you overpaying your mortgage, or are you doing a bit of both? Jump in the comments and let us know why you are actually doing what you are doing. If you've enjoyed today's video, I think you're going to love the very next one, which is all about 8 investments you must have by the age of 45. I'm going to link to it below and over there to the right hand side for you to head over and check it out.
Thank you guys so much for watching this video, and as always,
in all things, be thankful and seek joy. Take care, people.
Take care.
Bye. It's a wrap.